G'day everyone, back to Pete's Investing. Today we're going to be talking about a simple trading strategy using the CCI or Commodity Channel Index and averaging down technique. Firstly, our rules. To open a position, we're looking at the moving average of the CCI 100 breaking above the zero. So this here is the black line is the CCI 100, that's the zero line on the blue line. And the red line is the moving average of the CCI 100. So when it breaks above the zero, we look at opening a position. That's the only condition we make at this point. To close a position, there's a couple of criteria. Firstly, the close price needs to be above the position price where we entered. So the close must be greater than the position price. And secondly, when the CCI 100 moving average of 20 breaks below the zero line. That's our close. When we buy low and sell high, that's when we close it. So this little trade would have made our little profit. When price goes against us, we use the average down technique. So the calculation goes as such. When the CCI 100 breaks above zero, in other words, it's moving in a positive direction, but the close is less than the position price. And gap 1 is greater than gap 2, and I'll explain what gap 1 and gap 2 are in a few minutes. So firstly, gap 1 is a position price where we entered the trade is greater than our close. In other words, the price has gone against us. So we calculate the difference between there and there. That's gap 1. Gap 2 is 2 times the highest close of the last 30 days minus the lowest close of the last 30 days. And I'll jump to a slide or to a chart, a price chart, to explain how that works. So as you can see here, I'm looking at the 15-minute chart of the US 500 cash. So let's first look at the 30 bars or the 30 days. So each of these are 15-minute bars. So it's not actually 30 days, it's 30 bars, so 30 15-minute bars. So you can see there, in this little example, it's 30 bars long, and the average high minus the average low is 35 points, and that's ballpark consistent with, if you look at down here on the blue line, when it comes up, at 61. So what we're saying is 2 times the 31, in this case 35, rough ballpark roughly, 2 times that is 61 points. So when the price drops at 60 points from our opening, and the condition is the average down condition is met, the CCI 100 breaks above the zero, and the close is less than the position price, and gap 1 is greater than gap 2. So we said gap 1 is meaning the close is less than the position price. Gap 2 is true, that's 2 times the gap. And we said gap, the highs and lows of the last 30 days times 2, so in this case 35 times 2. And I've done another calculation here on 90 bars, and that's also consistent with 54. So if you look at that there, if I change this to 90 bars, at that point there, you look down here, that's 51. So that 51, the calculation is consistent or close to 54. I'll make that change to 30 bars. Just demonstrating how it calculates the highest high minus the lowest low calculation of 30 bars. So again, moving that, if you look down here, that's saying 34, and that's ballpark 34 there. So we're saying 2 times that if we use 30 days, 2 times that if we're using 90 days, and I've done one more here for 120 days. So that calculation, we'll make a change to 120 days. So if you look down here now, that's 67. That's ballpark 65. So again, 2 times 65 is our entry point if it goes below there. So what we're saying is, in summary, if we choose, let's say, the 30 bar calculation, which is 35 points, we need to say, what we're saying is the price needs to drop about 70 points before we can look at an average down entry condition. Now, this program is using 30 days, so let's change this back to 30. So at that point there, this is our entry point there. At that point, we entered our second entry. And if you look down here, the calculation shows 34. So 2 times 34, and we said it's 35 ballpark, it's just a ballpark calculation. 2 times 34 is about 70. What we're saying is if the price is greater than 70 points, so if we draw our line from our opening down to this point, you can see there, it's 96. So it's 2 times 35 is 70, 96 is greater than 70. It's met our condition for our second entry there. So going back to this, our average down entry is the CCI 20, moving average 20 breaks above 0, the close is less than position price, and the gap 1 is greater than gap 2. So gap 1 is that's true, it is lower than our entry price. Gap 2 was true, it's 2 times 34 we calculated, so it's the highest close of the last 30 days minus the lowest close of the last 30 days. So we're looking at about 70 points at least in the red. Then we do a calculation. So what we do here, this is based on that chart I just showed you. In this example here, we entered our first trade there. We entered our second trade there. Let me just get rid of some of these. Ruler. Let's clean it up a bit. So we entered our first trade there, our second trade there, and third and fourth trade before the price reversed. And this gives you an example of where those were. So our entry point at the first entry was 35.27. Average price after the second entry was 34.84. So we entered there. That's not 34.84, but that's where the average price is between that and that. Our entry point down there was whatever the price was, but our average price was 34.32 at this black line there. And lastly, we entered another final one down here. So the average price became 33.89, which is that black line there. The price reversed. The CCI in this example broke above, turned into negative, broke below the 0 line. The close was greater than the position price. The position price was, at this point, the average there, and it is greater than the 33.89. That pink cross is where it closed. And gap 1 is greater than gap 2, so it's gone by at least 70 points above, and that's where we're exiting. And that's our little exit point. So, in summary, we've entered the trade. In an example where we enter the trade, looking back here, for example, we entered low, closed high, it's closed above, the CCI broke below, so we closed, and it's a nice little profit there. That's what those bars indicate. And when the price goes against us, as in this example, we entered our first entry there, entered our second entry using the average down technique, third entry, fourth entry, and then price reversed, and we closed out there. You can see there it closed out those 4 positions at 34.83. Thanks, guys. I hope that was useful, and obviously there's many other techniques to average down. We don't want to enter too many times because that'll just pull in on all our margins. We want to make sure the price goes down enough before it starts re-entering again. There are many other techniques we could have used to enter the market, but this is just one entry method we're using to average down. Okay, I'll speak to you guys next time with some more information. Thank you.